Good afternoon. This is Tony Cherniawski, President of the Practical Investor, LLC. Today is October the 22nd, 2008. The name of the program is Options Madness in Today's Market, Part 1. What I'd like to do is begin by just highlighting a little bit from our prior segment. One of the things that I had said is that options can be used in moderation. They are neither good nor evil. It's just how they are used or misused that makes all the difference in the world. Options have a dark side. They are not insurance, yet many people think of them as portfolio insurance, including major insurance companies. They do not protect against a specific risk. Rather, they are a transfer of risk to a counterparty. Many insurance companies have even started to use options as a means of protecting their clients in annuities and in retirement plans. Unfortunately, this piling on of people using options has also aggravated the risk situation in the market today. So one of the things about counterparties, by the way, that I just need to mention is that they may or may not be capable of even paying off a liability, and especially in a rapidly declining market. What will happen is that literally in a rapid decline, the liabilities can be unlimited and unmeasurable until the market expires or the options expire or mature. Think of the options market as a big casino where investors place bets on the direction of the market. If you win really big. If you lose your entire option premium. Virtually 99% of all options expire worthless. It's important to know that if you're thinking about using a strategy of investing with options. These are not friendly devices at all. So in the case of a casino, as you well know, in Las Vegas or in Atlantic City, the house almost always wins. And this is the same thing with the options market as well. Now, let's talk about some specific times in the marketplace where Options Week came in and played an important role. The first one is in August of 2007. You can see here that Options Week began with the blue arrow. And we were in a fairly comfortable zone. One of the concepts I want to bring up is what I call the no pain zone. This is where the put options are equal to the call options. In this case, Wall Street is fat, happy, they're making money. The option premium more than covers their risk. They can handle a variance of anywhere up to about 2, maybe 3% either side of this no pain zone, and they're very comfortable in that area. This is one of the things that's been happening for 4.5 years between March of 2003 and August of 2007. So option sellers were becoming bolder and bolder. What happened was that index options, these are the Standard & Poor's index, for example, and the other classic indexes in the market, these index options matures on Thursday. So I've got the red arrow showing index options maturing at 1387. And by the way, stock options mature on Friday, and you can see stock options closed or matured rather when the Standard & Poor's reached 1438. The no pain zone was 1450, so the stock options pretty much matured in that zone. But the biggest area of liability is where the insurance companies and pension funds and large institutional investors are trying to buy this so-called portfolio insurance. That market really blew up on Thursday, August the 16th, 2007. So what happened here? Why didn't we have a crash at that time? Well, I believe what happened in the aftermath of the Thursday decline was that there was intervention because the market rallied up overnight all the way from its low at about 1370 all the way up to 1450 in the dark of night. This can only be done in the futures market, and one of the bigger players in the futures market, by the way, is the U.S. Treasury and the Federal Reserve. So it's possible that these players got into the futures market and with fairly small amounts of cash can literally move the whole market overnight. And this is exactly what happened. If I were an option seller at that point, what I would have done is bought calls at the bottom of the market at pennies, virtually pennies, and I would be able to sell those calls for dollars, even tens of dollars, or even hundreds of dollars at the top the very next day. Quite a smart move, because I believe that the options market, rather the house, meaning the option sellers, potentially lost as much as $500 billion at the end of the day on August the 16th, but it's possible that they made most of that back by purchasing calls on individual stocks for the very next day. Let's move on to January 2008. This is another example right here, but in this case the market failed. You can see where the index options matured. By the way, the no pain zone was around 1400. I believe it might have been a little higher than that, but the week began in the no pain zone, but it very quickly deteriorated. So that index options matured about 50 points lower at 1348, and stock options matured at about 73 points lower at 1327. What happened is immediately after that, the market sold off. That's important for us to realize, so that the way the option sellers handled the risk here is by doing what we call gamma hedging, which means they sold short the market after options expiration. This is another way that option sellers can refill their book and pay these liabilities off. It's possible at that time that a couple of the major players may not have been able to do that. One of them was probably Bear Stearns, and the other was Lehman Brothers. These two companies were very active in the options market, and so it's possible that these two companies really took a hit from that and weakened their financial strength considerably at that time. Finally, we're looking at March of 2008. What we're seeing here is that between August and January, we had 22 weeks of relatively low volatility market, although the market was going down for 22 weeks. On the other hand, the March options expiration occurred only 8 weeks later, and look what happened. The options expiration week began on the 17th. Over the weekend, on the 16th, we heard that the Lehman Brothers and Bear Stearns was taken over by J.P. Morgan Chase. Lehman Brothers, it was rumored that they were in trouble. J.P. Morgan bought Bear Stearns for $2 a share plus a guarantee of $31 billion that the liabilities wouldn't come back to bite them. Lehman Brothers went from about $55 a share all the way down to $20 a share on the 17th, but rallied up to $50 a share on the 18th of March. Very quick rally. It hardly seems possible that any individuals could have done this. This had the mark of institutional, if not government, meddling in the options market. I'm going to end here for now, but we have another segment to go. I can be reached by email at tonyc@thepracticalinvestor.com, and you can also visit my website at www.thepracticalinvestor.com. One of the things you'll note on the page is that I have a crash warning. I believe the market has been very destabilized by the options market, and this is one of the reasons why I'm putting this video out. Thank you very much, and do the right thing.